Hey traders, and welcome back to another episode of Trade Like Assad. Today, we're taking a closer look at an essential skill every trader should master: spotting buy-side and sell-side liquidity in the market. Liquidity zones act as covert tools that institutional entities often exploit to steer market sentiment. One of the key reasons traders end up on the losing side is their inability to correctly recognize and interpret these zones. In this advanced session, we're going to break down the psychology behind liquidity zones, the candlestick formations, and the price action patterns that typically emerge in these areas. You'll gain clarity on how these zones operate, and more importantly, we'll arm you with the insights needed to safeguard your capital from unnecessary risks. So traders, if that's something you're excited about, hit the like button to show some love, and don't forget to subscribe if you're new here. See you right after the intro. Welcome back, traders. Let's dive right in. Buy-side and sell-side liquidity are key components in the overall market structure. Price tends to gravitate toward these liquidity areas consistently. The market essentially flows in a loop between buy-side and sell-side liquidity zones. Think of it as a constant cycle. Price shifts from sell-side liquidity to buy-side, and then back again. These zones can act as a blueprint during chart analysis, helping us stay a step ahead of the market and make more informed trading decisions. Now, let's quickly break down each zone and uncover the psychology driving them. Picture the price moving into an accumulation phase, as shown. In this phase, we observe price forming equal highs and equal lows before initiating a markup or markdown move. Within this accumulation range, we can clearly identify a support level at the bottom and a resistance level at the top of the structure. It's quite common for retail traders to enter buy positions when price hits the support, placing their stop losses just below that level. This action forms a dense liquidity zone underneath support, made up of stop loss orders from those buy positions, just waiting to be triggered by price movement. This zone also includes sell stop orders from retail traders expecting a breakdown, believing that if price breaches support, it will kick off a markdown phase. Now, on the buy side, when price approaches the resistance sitting at the top of the equal highs, we see a similar pattern. Many retail traders aim to sell at that level, placing their stop losses above the resistance. We also recognize a concentration of buy stop orders from traders anticipating a bullish breakout, expecting the price to continue upward if it breaks past that resistance. Together, these behaviors create distinct liquidity pools made up of multiple order types sitting just above the equal highs and below the equal lows. So in this case, buy-side liquidity is positioned at the top of the accumulation range, and sell-side liquidity rests at the bottom. Though they represent opposite directions, they fundamentally reflect the same market mechanics. Buy-side liquidity refers to a zone on the chart where buy-stop orders are stacked, typically placed by breakout traders, and where short sellers have positioned their stop losses. This zone lies on the buy side of the price action. On the flip side, sell-side liquidity represents a chart area where long-position traders have placed their stop losses, and short sellers are looking to enter via sell-stop orders. This region is found on the sell side of the market. Now, let's examine how the market tends to behave when it approaches these buy-side and sell-side liquidity levels. Let's consider a scenario where price is climbing toward equal highs, and retail traders begin selling as it approaches the resistance level, setting their stop losses just above it. If the price pushes higher and breaks past that resistance, it not only triggers the stop losses of those retail traders who went short, but also unleashes significant buying momentum as those short positions are forcefully closed. At the same time, it activates the buy stop orders of traders looking to enter long positions on a breakout. This chain of events causes a strong wave of buying activity and introduces inefficiencies near the top of the structure, which can further motivate additional traders to jump in on long trades after noticing the intense upward pressure in the market. Now, let's examine how the market behaves in these conditions. Every time a buy order is executed in the market, there must be a seller on the opposite side willing to provide the asset, and the same holds true in reverse. Now, let's suppose that major financial institutions want to accumulate a large position in a currency pair. To do this effectively, they need a substantial number of sellers and corresponding sell orders in the market. This is crucial, because without enough sellers, those large buy positions can't be filled. That's why institutional players often rely on existing stop losses and buy stop orders already placed by retail traders, they use these orders as liquidity sources to execute their buy-side trades. On the flip side, if smart money wants to initiate a significant sell position, they require plenty of buyers to step in. The market doesn't always have enough active liquidity to support large-scale selling, so institutional players can't just dump their positions instantly. In such cases, it's commonly believed that smart money may steer price action in a way that misleads traders into thinking they've identified the correct trend. This engineered price behavior causes retail traders to enter positions confidently, only for the market to reverse toward their stop losses. Once those stops are triggered and enough liquidity is gathered, the market then resumes moving in its intended direction. Let's take an example where smart money intends to place a large sell position. As price climbs toward the buy-side liquidity, it breaks above the resistance level, triggering the stop losses of retail traders who had earlier entered short positions at resistance. At the same time, it sets off the buy-stop orders of traders entering long positions, believing the resistance has failed. This chain of events brings a strong wave of buying activity into the market, creating the perfect setup for smart money to execute their sell orders. By manufacturing a surge in buy orders, smart money injects their large-scale sell positions into the market. This results in a transition into the markdown phase, with price beginning to decline as their sell pressure overwhelms the temporary bullish sentiment. This example clearly demonstrates how smart money exploits buy-side liquidity and how it affects market direction. The same principle applies in reverse for sell-side liquidity. Now let's move on to the next section and learn how to spot buy-side and sell-side liquidity through candlestick formations and various market setups you'll come across on the charts. We've already covered equal highs and equal lows as key zones for buy-side and sell-side liquidity. Now, let's shift our focus to swing points as another source of potential liquidity, specifically from a candlestick analysis perspective. A candlestick swing low forms in a three-candle sequence and is identified by the lowest low that sits between two higher lows on either side. In this setup, the middle candle holds the lowest point, while the candles to its left and right have relatively higher lows, qualifying it as a valid swing low. On the flip side, a candlestick swing high is also a three-candle sequence where the highest high lies between two lower highs. This pattern marks a significant point of resistance from a market structure standpoint. So, why does identifying these swing points matter? If a trader goes long near a swing low, they'll usually place their stop loss just below that low. Likewise, if they enter a short near a swing high, the stop loss is likely placed just above that high. From this logic, the stop orders resting below the swing low are considered sell-side liquidity, while the buy-stop orders stacked above the swing high become buy-side liquidity. Recognizing these levels is essential in mapping out market structure because smart money tends to drive the price beyond these zones to tap into those resting orders, allowing them to execute their large positions efficiently. Grasping this concept empowers traders to better anticipate price action and make more calculated decisions. Now let's move to the live chart and break down some real examples. Now on the screen, we're looking at the EUR/4 United States dollars hour timeframe. Let's begin by identifying swing points that act as potential zones of buy-side and sell-side liquidity within this ongoing bullish rally. Let's start with the most recent swing points. First, we spot a high at the top of the move, with a lower high to the left and another lower high to the right. This structure forms a classic swing high, and as a result, we can mark the buy-side liquidity just above this high. Next, we notice a low, flanked by a higher low on the left and another higher low on the right. That's our swing low, and it signifies the sell-side liquidity zone just beneath it. Upon closer inspection, we can identify another swing point, a low surrounded by higher lows on both sides. This forms an additional swing low, giving us another sell-side liquidity area further down the chart. Following this structure, we observe that price moves down and takes out the nearest sell-side liquidity, confirming that the liquidity sweep has occurred. After doing so, price shifts attention to the next swing low, which again fits our criteria, a low with higher lows on either side. On the upside, we also see that price has taken out the buy-side liquidity resting just above the most recent swing high. After the sweep, price forms another high with lower highs on both sides, creating a new swing high, and hence another buy-side liquidity target just above it. Let's move on and continue marking key liquidity zones as the structure unfolds. Once again, we can identify another swing low on the chart, which has just been swept by price action. Just above this area, we spot another swing high, establishing a new buy-side liquidity zone. What's important to note here is that this newly formed buy-side liquidity is located very close to the previous one. When multiple liquidity zones align in close proximity, especially on the buy side, it increases the significance of the older liquidity area, as it becomes a more attractive target for the market to revisit. Now looking further, we observe yet another liquidity sweep. Here, the price dips below a previous swing low, effectively clearing out the sell-side liquidity position beneath it. What follows is the creation of a new swing low, highlighted by a long lower wick on the candlestick. This wick signifies that sell-side liquidity is once again building just below this level, marking it as a potential area of interest for future price action. Now let's continue. We observe that price has entered a strong bearish momentum, aggressively pushing to the downside and eventually sweeping the most recent sell-side liquidity. Looking closely at the chart, we can identify another swing high. This high is flanked by lower highs on both sides, which confirms the formation of a new buy-side liquidity zone that should not be overlooked. Following this, price continues to push lower, sweeping the sell-side liquidity resting below the previous swing low. At the same time, it's clear that the market has formed another swing low, meaning we now have freshly generated sell-side liquidity beneath this new low. Let's move forward. Here again, we spot another swing high, confirmed by the presence of a lower high on each side. This marks another buy-side liquidity level resting just above that swing high. As the price continues, we see a downward push, targeting the sell-side liquidity. Notice how the wick of this white candle sweeps that sell-side liquidity zone cleanly. After this sweep, the market pulls back bullishly, heading toward the buy-side liquidity zone, and in doing so, it also creates a new swing high, adding another buy-side liquidity zone to the chart. Finally, we see the market push sharply to the downside once again, this time breaking through the sell-side liquidity with a strong red momentum candle. That's it, traders. Thank you for watching this video. We hope you found this video informative and valuable. If you did, don't forget to hit that subscribe button and turn on the notification bell so you never miss out on our latest content. Speech Balloon, your feedback matters. Drop a comment below and let us know what topics you'd like us to cover in our upcoming videos. Folded hands, thanks for your continued support, and we look forward to seeing you in the next episode. Until then, trade smart and stay sharp.